Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
You're listening to Top Traders Unplugged, episode number 006, where we continue our conversation with Tushar Chande, co-founder and head of research at Rho Asset Management.
Regardless of what our testing may have been, you can see and look at our real-time track record and see that we have controlled our risk very well on a daily basis as well as on a drawdown basis for the entire program.
And so once the position is on, I guess there are two schools of thought. Some managers actively manage their position size, and some people leave them as is. What's your preferred way of doing things, and why did you choose to go this route?
Yes. Again, if you remember, Niels, when we started off, we said that we're trying to think like or capture the behavior of discretionary traders. So if you're a discretionary trader, your typical style is you're a little hesitant to get in, you're slow to get in. Once you get in, you may get in with a large size or a small size based on your feeling about what the trade is going to do. And then some discretionary traders will adjust their position on day to day, but most will just leave it alone. And so that's the same thing as trading with a very wide stop. And then suddenly something will happen in the environment. There'll be some news item, like, for example, the events in Ukraine this weekend. And then you'd come in on Monday morning and sell all your positions. So then suddenly your stop that was very wide will instantly become a market order to exit. So our stops behave in a non-linear fashion, and we use many different exit strategies in combination so that, and there are different strategies in different systems, so that we are looking at things like market volatility, things like overall volatility, things like time in trade, to decide whether our stop should be far away or close together. Now, part of the reason we can do that is because we have a breakout style system. That gives us a much better ability to manage open trade risk, for example, when we had the fantastic rally in Swiss franc some time back. If you are a moving average type manager, or if you're a manager that wants to control your risk in a narrow period, then what people do is they will say, look at some period of time, like 100 days, and measure their standard deviation over, say, 100 days, and say that we don't want to increase our 100-day standard deviation or VAR or some other measure of volatility beyond certain level. So let's say that we'll just, for simplicity, we'll say that we use a 100-day standard deviation, and we don't want that to exceed, say, 2%. So if the 100-day standard deviation becomes 2.1%, then they will reduce their positions so that the volatility will now gradually come back below 2%. Now, this is a complicated process that adds to the cost because it increases the frequency of trading. It also means that sometimes you're penalizing a position that's being profitable and has a long way to run. It also means that there's always some lag between the time that you decide, okay, I need to adjust my position, and what the market volatility actually does. So in many ways, trying to actively manage your equity curve imposes an external exit condition on your models, which really can't be tested because you don't know what the volatility is going to be in the future. So we feel that our approach is a much better and cleaner approach that can be more easily implemented. And clearly, our real-time track record shows that we have controlled our risk, in a reasonable way. So we feel that our approach is more consistent with what's best for in terms of returns and versus risk, and also more accurately captures the behavior of discretionary traders. So it's a way for us to differentiate ourselves, and it's also a lot simpler than trying to actively manage our equity curve.
And of course, we are talking about the main trend following models in the overall program. And just out of curiosity, would any of them use any stop profit targets, or is it just stop losses that you would use, even though, of course, a stop loss could happen and exit a profitable trade?
Yes. We do not use any profit targets. Now, this is one of the core principles of trend following. If you study trend following and you look at a distribution of the profit and loss from individual trades, what you see is that you have a distribution that is skewed to the right. What that means is you have one or two trades that are extremely profitable, where you make virtually all of your money, and then you have a few trades that are, and most of the trades are somewhat profitable or somewhat unprofitable, and they tend to cancel each other out. So the whole philosophy of trend following is profitable over the long term because you are not in a rush to get out of your position. So we like to say that we take our profits slowly, but cut our losses at once. So top scorer, if you will. And given that philosophy, which is central to the core principles of trend following, we feel that there is no particular reason for us to have a profit target because that would be counterintuitive. Now, obviously, if the markets are in a narrow trading range or even a wide trading range where they're trading between some upper bound and some lower bound, then obviously a profit target makes sense because you're going to take a profit against this boundary either for a long trade or a short trade. However, we know at some point there's going to be a breakout, the market's going to start moving and have a fantastic trend. And that's what we want to capture, which means that we need to put on as large a position as we can, as quickly as we can, or as close as we can to the start of the trend, and then to carry it up or down as close to the critical end point of the trade as we can. And that's what we've tried to do, and that's why trend followers have been successful over the long run. So we feel philosophically there's little justification for using profit targets because that's self-defeating, even though they obviously would be attractive during some months because of the markets trading in a narrow or wide trading range.
And of course, you mentioned something interesting. You're saying that what you're trying to achieve is to get the biggest possible position on for hopefully a very long-term trend. But how do you distinguish? Do you use any kind of variable position sizing that allows you to do that, or is everything fixed in advance with taking the same level of risk every time you get a signal?
The answer is that we actually have a way to change the initial risk on a trade algorithmically using fixed rules based on what we see happening in the market. So again, in our discussion about how we are trying to capture the trading strategies of discretionary traders, we've said that in some cases, discretionary traders will feel very strongly about a trade because, say, as we said, give the example of a change in leadership in a country like Japan. So you can put on a much larger size. Or, for example, you knew that when the Fed decided to intervene or start QE2 after the famous speech by Dr. Bernanke at the Jackson Hole meeting, you could use that as an input and put on a very large position in equity markets because you knew what was coming. It was telegraphed very clearly. We don't have the luxury of doing that because we use the same rules and we want to use an automated process. But we do have a process by which we don't have to take exactly the same risk of however many basis points per trade for eternity, but we sometimes use what we call a booster. So we have, for our trend following products, we can either go in one step, we can have 1x risk and step it up to 2x risk, or we can go in steps. So we could go with 1x, 1.25x, 1.5x, and so forth. So now, why is that relevant? Because unlike some other trend followers, we're not trying to add to positions. So our whole focus is trying to put on as large a position as we can, as close as we can to the initial point of the trade. So that's why we spend a lot of time trying to come up with algorithms that allow us to automatically change the risk from, say, 1x to 2x in some form, either in a single step or in multiple steps, so that over time it does add significant value. And as we know, we just have to get it right once or twice a year to make a significant difference over a long period of time.
And so now, in a sense, we've talked a little bit about the sort of the trend following side. Three of your systems you mentioned are following this type of approach, but of course in slightly different ways. But you also mentioned you had a third group that trades slightly differently. Perhaps you could just sort of summarize some of the points we've talked about on the trend following systems, but put it into the context of this third group that, I guess from what you've said, is what you use to try and protect against sort of big events in the markets.
Correct. Now, if you study trend following and if you have invested with trend followers, you know that one of the primary failings of trend followers is that they're not quick to recognize key turning points, and that's by design, because we know that we've discussed that we want to put on as large a position as we can and hold on to it as long as possible before we exit, in order to capture these very, very few mega trends that occur randomly in the markets. So because we are positioned to capture the mega trends that go on forever, by definition, we have to be able to sit back and absorb a lot of volatility, a lot of counter moves to the underlying trend, because we don't know where the counter trend move is going to stop and continue so that the trend will resume. So that we've addressed using our first two groups of systems. Group 3 systems are really a counterweight to groups 1 and group 2, where we say that, yes, we know that some trends are going to go on forever, and we have that capability using groups 1 and groups 2, but we still need to have some buffer in the portfolio. And we also have mentioned that one of the key design features, or one of the key reasons why investors or allocators would like to have CTAs in their portfolio, is to be able to react and offer a positive offset when there are sell-offs in the equity markets. Now, in the good old days, these sell-offs used to be very gentle and used to come on very slowly. But now with automation and computerization and Twitters and all the tremendous speed at which information can be dispersed from one point to another, the rate at which markets respond to a perceived adverse event is much faster today than it was 10 years ago or 15 years ago. So that's the challenge that we're trying to address with our Group 3 systems. Now, what's the other side of the coin is that we cannot have a system that's so sensitive that it's going to change positions, for every little wiggle of the market. So we need to obviously smooth out some of the market volatility, and yet somehow be able to recognize that this change in the direction of the market is potentially more significant than some other change in the direction of the market. So you can see that there's always some trade-offs involved in terms of how fast you want to react and so on and so forth. But what we've done with Group 3 is we've primarily designed it to go short the equity markets and go long the bond markets when you have a rapid reversal in the equity market. So we're trying to reinforce the primary reason for owning CTAs in the design of our Group 3 systems.
Excellent, Tushar. And just out of curiosity, do you just as a kind of a give a benchmark idea about how different the models are in terms of their trade length, and just to give the listeners an insight to how long they're looking to be in a position for?
Right. So our first two groups, which are trend following in nature, are trying to hold a position from, say, 1 month to 3 months. And the Group 3 systems are typically holding it shorter than 1 month. But we don't have any systems that are shorter than 2 weeks. So if you just use 2 weeks, 1 month, and 1 quarter as the rough benchmarks, then our longer term or medium term systems will hold a trade from, say, 1 month to 1 quarter, or a little bit more than 1 quarter. And then our Group 3 system will hold it, say, approximately 1 month or maybe a little bit longer.
Let's shift gear a little bit, Tushar, away from the individual models and just talk a little bit about, how trade implementation takes place. Maybe you could just run through a little bit about, how many times you need to run your systems per day when it happens, and maybe also a little bit about how long it takes to run a whole program like this.
Typically, we've said that we are an end-of-day trader. So, Niels, we only need to do it once a day. But what do you mean by once a day? Because we have many different time zones. We have some markets that are in the Pacific Rim, so they have their own time zone. Then we have markets in Europe, which have their own time zones. And then we have markets in the US, which have their own time zones. So in effect, we have to run the system once a day in each of these time zones. So even though we're running the system once, we actually have to run it 3 times, except of course on a holiday or a weekend, because we are catering to 3 different time zones. Now, typically it takes somewhere on the less than 30 minutes to run the system. Sometimes it may only take 5 or 10 minutes to run the system, because we have to download the data. It's totally organized and systematized. We just run it. It spits out the tickets, and then we send the tickets on to the brokers, and you're done. So some days it might take a bit longer, but typically we say less than 30 minutes. So somewhere between, say, 10 and 30 minutes should take care of just about everything you're likely to encounter during a year.
And I guess there will be days where your system doesn't even have to, doesn't even trade when it is a medium-term trend following system. Would that be right?
Correct. We have about 800 to 1,000 round turns per million per year. So we're not, if we have, say, there are many days where you may have no trades at all. Typically, we'll only have 1 or 2 trades a day. And on a busy day, we may have 4 or 5 trades. So if we have, say, more than 5 trades and we're having a very busy day, and most of the time we're doing between 0 and 2 trades.
Excellent. I also wanted to talk a little bit about sort of risk management. I know you've touched upon it in your talk about how the models work, but I just want you to try and maybe describe and define what you mean by risk and how the program is taking that into account. You mentioned the integrated risk management as being part of the design. So maybe you could speak a little bit about that, and also how you report and inform investors with regards to risk, because obviously many investors are very focused on this particular point.
Yes. Niels, we are very aware of risk. As CTAs, one of our primary responsibilities is to control risk. We have a lot of leverage, and the leverage is a two-edged sword. So, it's very easy to get nicked. So what we've done is, because of the design of our systems, we are a breakout style trader and so forth, as we've discussed, and we're putting on a position all in or all out, and the number of positions can expand or shrink. What we've done is we've embedded our entire risk management into a single integrated trading platform. But what you also have to recognize is that risk management is not strictly a number like calculating VAR. It also means being aware, fixing any trading errors. It also means being aware, submitting the orders on time, confirming that the brokers have received our tickets, and so forth. So the risk control is a very elaborate process that involves many different activities, making sure, for example, that our statements check out every day, that there are no out trades, that the trades are on our statement are also the trades that we should have based on what trading we've done. So to knock out and eliminate and fix trading errors and so on. So risk is in many different forms. But the simplest form that everyone thinks about is value at risk, which is typically a one-day event. And we certainly provide all that because we have NAV Consulting, who is our outside accounting resource, will give you very elaborate reports which give you detailed insight into all the positions and what they've done today and this week and this month and this year, with all the value at risk and so on and so forth. So all that information is available, and we'll give it to you free, and we'll update it every 24 hours, and it's provided by an outside third party, so there's no opportunity for us to play any mischief. Now, what we have done is that rather than worry about just value at risk, which only gives you 1 day's worth of control, we're taking a much longer view, and we're trying to limit our overall peak to valley drawdown. Now, I've already told you what our model is. Our basic model is that for a diversified trader like us, the drawdown risk is typically 3 to 5 times the monthly standard deviation. So part of our job is to make sure that we've arranged our risk and initial risk so that our long-term standard deviation is around 5%, a little bit more, a little bit less, based on what's happening in the markets. And so our risk, multiply that by 4, is about 20%. And we've done approximately that, a little bit more, a little bit less, depending on which particular time window you look at. So we've gone beyond merely looking at 1 day's risk in terms of value at risk or so forth, but we've also tried to limit our total peak to valley drawdown risk. So that's quite different from what other people have done, and we've totally integrated this into our algorithmic process So not anything we need to think about. It's just automated, and we push a button and it takes care of itself seamlessly. But we've also gone beyond just looking at drawdown risk to also worry about avoiding trading errors, making sure that all the tickets go out on time, making sure we have proper backups for data and so on and so forth, and our various trading records and software and servers and all of the back office infrastructure needed to automate and deliver a very consistent execution process.
And just out of curiosity, correlations. A lot of people talk about correlations, and a lot of people put a lot of emphasis on that. Just very briefly, what kind of approach did you take to the point about correlations in your risk management?
Typically, the problem with correlations is that correlations are not static. So if you look at the correlation from, say, one group to another group over yesterday, over the last 10 days, over the last 10 years, you get very different answers. So we've tried to avoid using correlation directly or explicitly in our day-to-day risk management, because it's too unstable, and also doesn't fit with our problem that we don't have the same number of positions every day. Sometimes we can have a lot of positions, sometimes we have very few positions. But of course, by saying that in our overall long-term test, we've adjusted our initial risk to maintain a certain long-term standard deviation. In effect, we have smoothed out the correlation between the different sectors into a single number, and it's smeared into a single number called our long-term standard deviation. So we're not looking at day-to-day or week-to-week changes in correlations because we think they're too unstable, but we have implicitly absorbed and averaged out the correlations between sectors over a very long period of time.
Now, drawdowns is, of course, part of, the risk management is, of course, trying to avoid too many drawdowns, but drawdowns are important, and it tells a little bit, I guess, about how the design of the program has been done. Maybe you could just recap for me. I know you mentioned that the worst drawdown of the Algos program occurred in February 2010, lasting 20 months. Perhaps you could tell me a little bit about how long time it took to recover this drawdown initially.
We've recovered in 18 months. And again, you have to think of this in the context of what was happening in the environment. To go back to where we were, was it a very windy day on the golf course, or was it a very rainy day on the F1 course, or was it icy at Sochi, or it was very slushy for the skiers in Sochi, and so forth. So you have to think of the time to recovery in terms of what is happening in the environment, what is happening in terms of the portfolio weights and the system design, but our recovery time is 18 months.
And I guess this is sort of a little bit of a philosophical question, but the drawdown profile that you wanted to create in, with your design of the program, does that take into account the kind of investors that you want to attract, or is it more sort of a personal taste, meaning that some people have very clear ideas and opinions about what is the best way to trade the markets, both from performance and a drawdown point of view, or how did you go about ending up with the profile that the Algos program has?
We had a very clear design philosophy, as we said, in terms of why we're putting certain systems together, why we have different groups of systems in terms of how we want to respond to the markets, and then also by the breakout style and how we've embedded all the risk management all into the overall design of the systems. So it's hard to find a consensus on what's the best way to do this, because clearly different people, someone may have a trading horizon of 10 minutes, and holding a position for 2 minutes is a very long time for them. On the other hand, there could be some traders for whom holding a position for 3 months is too short for them. So, managers as well as investors come in many different types of preferences. We tried to find a solution that we think is sustainable, that expresses our belief that you need to carry the trade as long as possible. You need smart exits, you need smart entries. You need to have smart risk management. You need to have smart initial risk allocations. So we've tried to be adaptable and flexible while using the same rules on all markets. So in many ways, these are difficult conditions that you somehow have to reconcile and trade off. And I thought we've done it pretty well.
Tushar, I wanted to jump to something different. I wanted to jump to something that is very close to your heart, and that's the point of research. And maybe you could just talk a little bit about sort of your general, research cycle and how you go about these research reviews.
Again, that's well. First of all, we do research all the time. We are constantly thinking about is there a better way to do what we do, and of course we have to account for what's happening in the markets. And there's always a question of are you changing too soon, or you're not changing quickly enough? And sometimes it's really difficult to answer these questions because they're ambiguous. And as we said at the very beginning, we live in a world of randomness. So it's not a cause and effect world, in other words, which means that just because you made a change doesn't mean that you're going to find out whether the change has been any good for quite some time. And then conversely, you may not get any benefit from the change for a long time. So making changes is a tricky business. My certain view is that we're doing research all the time. If we can find a significantly better way to do things, we're happy to make the change. In general, in my experience, it's best to make a change when you're at a new equity high. And of course, the trading conditions have been difficult, so we've had to make some change in the responses based on the unique role that central banks have played in the last few years, which probably won't be repeated for quite some time, hopefully. So I think it's a tricky question, but you always have to keep doing research, and you have to keep asking yourself whether this is the best time to do it. But it really goes back to the basic design philosophy and the structure of the program. And I think if you're clear on that, then it's very easy to decide whether a particular change really adds value or not.
And if you look back since the inception of the Algos program, is there anything you could point to where you say these were sort of major research findings and perhaps what prompted you to discover what you discovered and make the change?
Certainly one of them was the major role of the central banks, because clearly if you look at the data leading into the crack up of Lehman, there's nothing in the data in the last 15, 20, 25 years to indicate the extraordinary role played by the central banks. So they had a very specific effect on the bond markets and the equity markets that were really unprecedented. So that's clearly something that we had to come to grips with. Then the second part of this whole equation becomes being able to characterize the environment. Because part of the problem is that because the sectors were, or because the trends were so limited in terms of where they were occurring, we had to find some way of quantifying the trend strength. And one of the research outputs was something we call the Rho Trend Barometer that allows us to set the context so we can understand our performance and the performance of the others in terms of what's happening in our portfolio. Because as we talked about the sports analogy, a certain golfer's swing doesn't change necessarily, but the high winds are going to change the way he has to play shots. So the same way we need to understand, our system rules are preset. They don't know what's happening in the environment as such. So we have to decide whether a particular set of rules can be defeated by the environment due to what's happening.
And how different is the Algos program today, would you say, compared to when you started off 6 years ago?
Not very different. As we said, we started off with 3 systems. Now we have 6. Our core systems, the first 3 systems, continue in essentially the same form with a few minor tweaks. And the new systems are consistent and reinforce or fill in some holes that were left in the design by virtue of the first 3 systems. But they're all breakout style systems. They have the similar design philosophy in terms of entries or exits or trade sizing. So in a way, we have not changed very much. And if you look at our live equity curve versus the simulated equity curve from day one of the system that we were using, they look very, very, very similar. but we've had to reduce our volatility in the markets because of the extraordinary events of the recent past.
Of course, investors always want firms to do research, and I don't know what your general view is. Of course, I guess a lot of people also believe that the more PhDs you have in your research team, the better your research is. But do you have any experience that you might share and view on this particular topic?
Well, if you just look at the track record of real life CTAs, you'll find that you don't have to have a PhD on your staff in order to have great returns. And having a boatload of PhD doesn't guarantee you that you're never going to have severe drawdowns. So having PhDs is not a necessary nor sufficient condition for great performance. Having said that, clearly, PhDs can add value, and especially for larger managers, they have more issues to grapple with, and they need more different kinds of systems. And like all individuals, certain individuals might be good at one type of problem, and some other individuals might be good at solving some other types of problems. So it's really a case-by-case basis, and certainly the larger managers can make a stronger case for hiring a larger research staff.
Is there something, by the way, about maybe doing too much research? I mean, can you overthink things? I mean, trend following have been around for 3-4 decades and generally has been very successful. Sure, we've had a spell now of 3-4 years where performance has not been great. It's not been disaster either. But is there something to say that you can overthink and do too much research, do you think?
Well, sort of a leading question, Niels. But yes, it's certainly possible. It's certainly a possibility that you can make too many changes. And as we've said throughout this conversation, we live in a world of randomness. So the mere fact that you have made a change in response to something in the recent environment doesn't mean that the change is going to produce positive effects forever into the future, because the market environment will change, and the market for sure will create a new environment that defeats whatever changes you made in response to some previous state of the environment. And you just have to look at the track record of the largest managers, which theoretically have the most number of PhDs and the maximum brain power, if you will, applied to the problem. And there are numerous examples where CTAs or managers have blown up or have had drawdowns significantly greater than their record previously or their research might suggest. So, yeah, maybe in some cases you might be doing too much research. But you have to remember that the more things change, the more things stay the same. I mean, trend following requires a certain discipline and a certain ability to absorb volatility and ignore the day-to-day noise of the business.
And before we jump out of the research area, at its core, in your opinion, why does these systems make money? Is it because of economic events? Is it fundamental? Why do these trend following systems make money over time, do you think?
Primarily because you have one or two really massively outlier trades that are hugely profitable and way more profitable than you could ever imagine or you'd be led to believe or expect when the trade is initiated. And that happens because there's some new information that changes the market or that has not been properly factored into the market. So, for example, think of the drought in California that's currently going on. Say this is the second year of a severe water shortage in California, so that's going to affect crops. It's going to affect the cost of feeding, say, animals and livestock, and so cattle prices are going up, or hog prices are going up. Now, no one knows when this drought will be resolved. We don't know how long the supply-demand imbalance will persist, and the markets will adjust and consumers will adjust, and then eventually the price will find some equilibrium. So the reason great trends occur is because there's some change in the background or the environment for that particular traded instrument, and the market is not quick to recognize, or the driving forces drive the bus or drive the trend far longer than expected. So if you look at the Swiss franc, which had an incredible trend a few months ago or a few years ago, it went much farther, much faster than anyone could have imagined. And this has happened over and over and over again because that's how randomness works. So the basic philosophy of trend following is that we have to wait for these mega trends to occur. and we can go through a period when there are few or relatively few or no mega trends as we've had in the last few years, or you could have a period where something happens that causes a huge trend in the market. And the only way to catch it is to be systematic and disciplined and put on your position and sit tight and wait for the market to go wherever it goes, which often takes longer and travels further than anybody expects.
Absolutely. Tushar, before we wrap up today, the CTA industry has gone through a rough time, as we've alluded to a couple of times during this talk. How do you see it overcome these challenges, and what is it that will perhaps reignite the interest in these CTA strategies, in your opinion?
Certainly, the primary way to reignite interest would be a return to profitability by trend followers. So that could happen when trends emerge. It could happen when there's a sharp reversal in the equity markets and CTAs can reposition faster than other strategies, as happened in 2008. It could happen when people realize and recognize that the role of central banks in the marketplace will diminish, as it will eventually, if not tomorrow, maybe next year or the year after. So certainly the emergence of interest will be driven by better performance by the CTA industry as a whole, by changes, by a lack of performance in other key sectors such as equities and bonds, and of course emergence of great trends due to supply-demand disruptions due to one reason or another.
Now, in the last few decades, we've seen an enormous growth in the number of CTAs, and therefore, obviously, I guess investors can find it hard to distinguish one from another. If you were just going to summarize sort of the key points about Rho and the Rho Algos program in particular, what would you say that is? What should investors take from this talk that you and I have had today?
Precisely what we said at the very beginning, that the primary purpose of CTAs is to provide offsets to portfolios of equities and bonds. And typically, these offsets have costs if you were to buy a put or some other form of protection. However, because CTAs can be profitable, holding them is less onerous, or can be less, it doesn't cost as much as buying an outright insurance policy. So I think the primary reason why we need to have a CTA in your portfolio is to give you offsets when there are sustained declines in the equity markets and the bond markets. And Rho has spent a lot of time and effort in designing systems that are geared specifically for responding to changes in the equity and bond markets over different timeframes. And we've demonstrated and proved that we can give positive offsets on time intervals ranging from 1 week to 1 month to 6 months to a year. And then we have to recognize that investors, by definition, are going to be long equity and long bonds. So the strategy that they're using is long equity and long bonds. So what is the offset to that strategy? Is the ability to go short, the ability to trade other instruments, the ability to react faster than their current strategies. And we deliver all of that in Rho. So I think we need to make sure, of course, that there's a high probability that Algos will make money, and we've done that, when there are trends in the markets. So the reason why we've designed the program is because we want to provide this positive offset. The reason that we are in the business is because we strongly believe that there is a need for investors to have this kind of offset capability, this sort of insurance or protection in their portfolio. They need to be able to respond at high speed. They need to respond consistently. They need to do it in an unemotional and consistent way so that you're not relying on the discretion of somebody. You don't have to worry about somebody's finger freezing on the button, if you will, because we have a systematic and disciplined approach to delivering this offset performance for the investor when they really, truly need it. When markets are moving rapidly, they're moving in a confusing way.
Now, just to finish on a slightly different note, of course, there are lots of listeners today who are not necessarily investing with CTAs, but in fact are trying to become a CTA. What would you say it takes to become a great trader or CTA in your opinion?
First of all, you have to be an optimist in this business to survive. You have to bring an original point of view, why you want to do it a certain way. And you need to be able to explain to people in a way that makes sense to them why you're doing what you're doing. And I think with those three things, you should be able to be successful as a CTA.
Tushar, this has been a great conversation. I appreciate your openness, your willingness to share your insights and your views on your strategy and Rho as a firm and the industry as a whole. So have a great afternoon. Thank you very much.
Thanks, Niels. Have a great day.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.